Welcome. I'm Mike with Penner Investments, and today I'm going to discuss an option strategy for smaller accounts. As I discussed cash secured puts last week, which is a strategy that requires a great deal of cash, credit spreads are an option strategy that requires a fraction of the cash that naked put options require. A credit spread is an option strategy that utilizes two put options at different strike prices or either two call options at different strike prices. You will sell one option for a credit and buy another option at a debit. It is called a credit spread because once you open the trade, you get a credit to your account. That's right, a deposit immediately after the trade is filled. For a put credit spread, I am selling a put option at a strike price while simultaneously buying a put option at a lower strike price, all on the same expiration date. For example, if XYZ stock is down to $131 a share, and I believe that it will not go below $125 a share, or even think that it may go up from this point, a put credit spread is the perfect option strategy for this situation. I can go out a week, or any date that I'm comfortable at setting the expiration date. Can go out to a month, 2 weeks, 3 weeks, 6 months, a year, whatever I like. Let's say I pick a week and sell a put option at the $125 strike price, and I get a credit for $83 while simultaneously buying the $120 put strike option for $25. This is where the spread comes from in the name of the credit spread. $83 minus the $25 gives me $58 credit to my account. This results in $58 being deposited into my account immediately as the trade is executed. Now remember, each options contract is for 100 shares, so the $5 spread, the $125 strike price down to the $120 strike price, has a maximum loss of $500 minus the $58 credit you get, so my maximum loss would be $442. This is the great aspect with credit spreads, that I am limiting my maximum loss and would only need $442 to cover a max loss in this situation. Now let's say I have a few $1,000s in my account. I'm pretty confident XYZ stock will not go below the $125 strike price. I can sell 5 of those credit spread contracts and collect $290 for this week's trade. Not bad, right? If I repeat this all month long and I'm successful on each trade, that would be $1,160 this month I could make off of this strategy. Keep in mind to never get greedy and do not sell more contracts than you can afford to cover. The market can always go against you quickly. It takes several successful trades to cover one loss. This is why I limit how long the trade is on for, and I try to stay far away from the current strike price as I can. This results in collecting less premium, but has a much less likely chance of my trade losing as well. The credit spread can also be done with the call credit spread. This would be done when you believe the stock would not go above a certain level. If XYZ stock is again at the 131 strike price, and I do not believe it will go above $140, I can sell a call option at the 140 strike and simultaneously buy the 145 strike call option. The credit on the call side is usually a little lower than the put side. Let's say I collected $25 a contract and sell 5 of them. This would give me $125 less any brokerage fees. So the maximum loss is still $500 per contract, less the $25 premium that I collected. So that would result in a max loss of $475 if I was 100% wrong. Please hit the like button and subscribe so you don't miss out on future content as well. Thanks for that. These credit spreads can be traded at any strike prices with any amount of spread. Just remember, the longer the trade is on, the more credit you will receive, but the longer the trade is on, the more risk you have of it turning against you as well. I prefer to stick to a week and a maximum time frame of around 30 days. Also keep in mind the amount of the spread determines the maximum loss. Everything with options is multiplied by 100, since each contract represents 100 shares. A $5 spread has a maximum loss of $500 minus the credit, and a $10 spread would have a maximum loss of $1,000 minus the credit. So keep this in mind when you're determining how far you want to set the spread. And this is just the basics about credit spreads. And you do not want to put too many trades in on one stock either. You want to try and diversify and do this over different stocks, because you don't want to bet everything on one stock and then it go against you and you have a big loss. You can also trade this strategy on index funds as well. That's right, this trade can be done on indexes like the SPY and S&P 500 index fund. Thanks for watching, keep learning, and happy trading.